us now with her reaction to the Fed's decision is Loretta Mester, Cleveland Federal Reserve, former president and CEO. Loretta, thank you so much for being here. I would love to start with Beth Hammack, the Cleveland Fed president who dissented from this decision. What are you seeing in Cleveland? What's going on in Cleveland that would lead her perhaps to dissent from the overall decision to cut rates?
Well, there can only be one Cleveland Fed president at a time, and Beth is that, so I'll let her speak for herself once the blackout period goes off. But, you know, this was a decision of the Fed. I'm sure they had a robust discussion at the meeting because, you know, there were some indications that inflation has been stalling out, at least been more sticky than they anticipated it being. And at the same time, despite the previous conversation, the downside risks to the labor market that they were seeing in September have eased off a bit. So I'm sure they had a robust decision about whether they should go ahead and do the 25 basis point move at this meeting or whether they should, you know, begin pausing. And I think what they did is they hit a very good point in the sense that, look, one way to think about this is, you know, they had told everyone that they thought 100 basis points of recalibration was probably required, and they fulfilled that. But at the same time, they signaled that, look, we're going to be going more gradually. And the chair had said that before the meeting, so this wasn't a surprise. They followed through on the communications that they indicated in this intermeeting period, which was, look, we've done the recalibration. We've gotten, you know, the funds rate down 100 basis points. Now we're going to have to really look at both parts of the mandate and look at the risks around that mandate. And, you know, perhaps we're going to go slower. And indeed, in the SEP, we see that at least the median path has one fewer 25 basis point cut for next year than the September SEP. So the messaging, I think, is a good message, which is, look, you know, we've done a recalibration. We got the funds rate down, which was appropriate given how far down inflation has come. Now we're in this point where inflation still has some more room to go. We may have to keep policy a bit more restricted than we anticipated to get it all the way back down to 2%, but we're in a good spot with monetary policy where we can react. Whether the downside risks to employment get realized, then we will cut a little faster. If it's really the upside risks to inflation that get realized, then we'll go a bit slower. So I think monetary policy is well placed at this point.
Loretta, you know, the decision, of course, does come as inflation is holding above the Fed's target there. So I am curious, when you look out, the trajectory of inflation from here, Loretta, looks like what to you?
Well, I think there's still a case for it coming down. I mean, some of what's happened is, you know, there are base effects in those numbers, but I think there are a lot of uncertainties out there. One is, of course, the fiscal policy actions. We don't know exactly what they are yet. We'll get more information over the next, you know, this intermeeting period up to the January meeting. We'll know a little bit more about that. And then the Fed can begin to take that into account. And that may have effects on both sides of the mandate, not only on the inflation part of the mandate, but also on the employment part of the mandate, you know, with you know, the immigration aspect of it, the tariff aspect of it, and the spending and taxing parts of it. So we'll have a little more information on that, and that's why the Fed can pause and assess at this point because its policy is well in place. I think that, you know, they're right in the sense that median seeing that inflation will come down. I think it'll take longer than was earlier anticipated, given some of the data that we've seen, but I do think it's still on that path. But they'll be able to adjust that as we get more information about how the economy is actually going. So I think they're in a good spot. And then they'll be able to react either to, if inflation does appear to be on the upside, they'll just hold at a restricted level for longer than they anticipated.
I mean, I guess, how much buffer do you think they have, right? Because you have to wait until the policies are actually announced instead of just, you know, talked about in advance. Then you have to wait to see what actual effect they have. Are there any areas that you're watching, whether it be on the employment side or on the inflation side, that might give you pause that they don't have that luxury of time to wait, if you will?
Well, when the chair says we're not going to speculate about what the fiscal policy was and then react to our own speculation, I think that's the right tact. But that doesn't mean that as information comes out, they won't be looking at what do they expect, or forecasting, well, what kind of effect could that have on our dual mandate goals of inflation and employment, and therefore build it into their forecasts and therefore react, with policy appropriately given what their forecast is. So I do expect the forecast to begin incorporating those fiscal policy initiatives when we have more information about them. But right now, we just have really what was talked about during the campaign. We don't really have President Trump's actual proposals yet. And so once that becomes part of it, there'll be analyses that are done, and FOMC members will start putting that into their forecasts, and therefore it will start impacting some of the policy decisions that the Fed has to make, because as you say, policy is forward-looking. But they're going to, just the way data comes in, it's not about what a data point tells you about today's economy. That's already done. It's really about what is that telling you about the outlook for the economy going forward. And that's what the Fed will react to, and that's what really determines appropriate policy, that and their forecast of the risk around hitting their dual mandate goals. So we will begin to see the Fed incorporating this into their forecast for the economy, and therefore it will begin to affect what they view as appropriate policy going forward. And we may know a lot more, once the inaugural happens and we see what some of those early actions will be from the Trump administration.
Loretta, we have to leave it there. Thank you so much. Of course, the press conference is going to be beginning in a few moments. Appreciate your time today.